Amazon Inc. is up 6% to $197 a share. This is news off their good Q3 earnings for 2024. Net sales is up, operating income is up, everything is up, and we're going to be going through those numbers in a second. Then we're going to be looking at my automated stock valuation spreadsheet to see if Amazon is a buy using the discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So, as I said, net sales up 11% to 159 billion compared with the prior year of 143. North American segment up 9%, international sales up 12%, AWS segment up 19%. That's 95, 35 and 27 billion. Operating income was up as well, 17.4 compared to the prior year of 11.2. This is the prior year third quarter. North American up 5.7, international 1.3, and AWS 10 billion. Net income all-time highs 15.3 billion in the third quarter. That's about $1.43 per diluted share compared with the 9.9 billion or 94 cents per share in the prior third quarter. Operating cash flow 57%. 112 billion in the trailing 12 months, up massively from the prior year. Free cash flow, trailing 12 months, 47 billion compared to 21. Everything is looking really, really, really good. So let's have a look at my automated stock valuation spreadsheet. What we'll do is we'll put Amazon in here, and this will load all the latest company financials, and we can see if this is a buy or a sell. So yeah, please give a like on the video while this loads, and then I will talk about Amazon in greater detail. Market cap 2 trillion, PE 42.42, slightly higher than the market, well, not slightly, a lot higher than the market average, which is around about 30. Earnings per share $4.64 and a beta of 1.14, meaning it is slightly more volatile than the market. Target price 220, so analysts are saying it is a buy. So here we have the numbers here. Let's go into some graphs or charts. All-time highs on the revenue, consistently growing, has not slowed down. Had a big jump up in 2020 and basically gone from strength to strength. 618 billion in the trailing 12 months. Net income, similar story. Yes, they were down in 2022, up again to 30, and basically smashed it out the park again with 49.87 billion. So the most profitable Amazon has ever been. In terms of free cash flow, trailing 12 months 15 here, down from the prior year. Let's have a deeper look here. This is the operating cash flow versus capex. We can see operating cash flow has increased. They had sort of decreasing operating cash flow in 21-22, higher capex. Capex is down a little bit. This is the red, and then basically all-time highs again. So yes, free cash flow is down, but the capex is up massively. Shares outstanding, we had some splits in here, but you can see basically the number has consistently gone up. So Amazon do consistently issue more shares, and they are using that, well, hopefully to reinvest into the business, but also, reinvest employees and things like that. So now let's have a look at my discounted free cash flow model. This is looking at the future free cash flow and discounted on today's value. We can see here it is estimating a negative price, so let's have a deeper look at these numbers here. I'm guessing this is because of this 2023 number has kind of messed it up. But firstly, revenue, we're expecting 163 and 773 billion in the coming years. Let's see if analysts agree with those takes. We're a bit more on the bullish side. You can see actually on the high side those are kind of those numbers. So we'll bring this down a little bit to about 7%. Net income margins all over the place, but we'll take an average of the last 2 years. 6.69, and here we are. Yeah, this is why, minus 164%. So let's bring it to the most recent year, which is 30%. That would put it in $24 stock. Realistically, if we were to take a sort of average of these years and this one here, which would bring us at around about 58%, still puts it at a $47 stock. So discounted free cash flow surprisingly does not really like the stock too much. Let's head into the Ben Graham formula for intrinsic value. This is looking at earnings per share, P of non-growth company, AAA bond yields, and with a AAA corporate bond yield at around about 4.95%. It's actually gone up 4.95. And analysts expect 5-year growth, well, per annum over the next 5 years at around about 31%. And still not a buy, but $163 a share. So Ben Graham does like the stock, but not that much. Really, we would need this bond yield to come down quite a bit. Somewhere in the region of 4% would be a lot nicer, but it's almost 5%. Ben Graham would not buy the stock. So finally, let's have a look at the comparable company model. This is a way of valuing companies, looking at similar companies of similar sizes and industries, then looking at certain metrics. We look at revenue, growth rate, net income, profit margins, price to sales, price to book, PEG, which is Peter Lynch's price earnings growth. Then we have EV to revenue, EV to EBITDA, P, and forward P. So because of my last video, we have some similar companies here. We have Apple and Google already. And for my final stock, what we'll do is we'll add in Microsoft, ticker symbol MSFT. And what this will do is we'll load the company data, and then we can have a deeper dive. So enterprise value, these are all 2 trillion and up companies. Amazon does have the highest revenue, and actually surprisingly has the highest revenue growth rate with about 19%, beating everyone here. Net income, about half as profitable as all the other companies, and you can see here on those margins, 8% compared to the 20s and upwards for the other 3 tech companies. Now this is because of a lot of Amazon's revenue is in the e-commerce side, which margins are not as high. Lowest price to sales, 3.36. Market average, I believe, is around about 3, so a bit higher than the market average, but not massively. Price to book, second lowest. Market average is around about 5, so that's good to see. Price to earnings growth is Peter Lynch's formula. Anything under 1 is undervalued, over is overvalued in his mind, and only Google comes close with a 1.06. Amazon is second highest, or second lowest, sorry, but not under the magic number of 1. So then we look at EV to revenue, EV to EBITDA, PE, and forward PE. And basically, we can see here, PE, Amazon is the highest. Forward PE, it is the highest as well. So that's why we're getting 160 and 137 on those metrics. Not really a buy, but EV to revenue and EV to EBITDA is a lot lower. Sort of the average of these, bringing a implied share value across these of $270 a share, saying it is a buy. So according to these comparing against these tech companies, it does look quite good. So actually what I'll do as well is I'm going to do another one here. We'll do cost and WMT, and then we'll just compare versus those 2 companies. Let me just do this. I think I broke the sheet last time I used it, but it does this and this one here. And now we can look at these companies and see if it is a buy again. Interestingly, no, not a buy. The EV to revenue is really bringing this up because it's so high multiples compared to these. It is not a buy at 111, but in terms of EBITDA and PE, it is a buy 230. But it brings an average price of around about 190, which is where the stock is currently. So yeah, probably about fairly valued. Oh, actually, I can do one more. Let me just do this. They are very similar, but not exactly. eBay, ticker symbol eBay, and oh no, I don't put it in there. Sorry. I don't remember how to use this sheet. We would put it in here, and then this should load. Obviously a lot bigger, but if we were to compare to eBay, which is, a similar business, or parts of it at least are, $150 a share down here. But hard to value Microsoft, hard to value Amazon, because very close to Google and Microsoft and Apple, but obviously the revenue side very similar as well to Costco and Walmart. But overall, the models are not saying it is a buy, but if we do look at the stock price over the last year, it is up around about 42%. 5 years up 120%, and if we compare to the SPY in that time, it will be easily beating the market over that 5-year period, 120% compared to 86, and probably anytime we look at it, yep, year to date up 30%, and yeah, beating it as well. So this stock is, and well, there's another graph for you right there. Right guys, thanks for watching. Please give a like on the video if you enjoyed it, subscribe if you're not already, and check out my Patreon as well if you're interested, which is here. I'll catch you guys next time.